Hello and a warm welcome to Advanced Audit and Assurance, your path to AAA excellence. If you're gearing up for the AAA exam previously recognized as the P7 exam, you're at the right place. In this video, we will walk through the past exam question. Get ready, we are not just studying the past exam question, we are unlocking the secrets to decoding the scenarios, finding numerous points we can make in the exam to gain marks easily, masterfully drafting answers up to the examiner standards, and skyrocketing your chances of success in the AAA exam. Stay tuned for game changing insights that will transform your approach and elevate your ACCA journey. Let's go ahead. In this video, we will be discussing March 2020 question number 1. As you know, this question number 1 is really important. It carries 50 marks in all and it is a briefing note question which needs to be attempted. And it carries 10 professional marks. So let us begin with this question. See, it is 1st July 20x5. Okay, you are a manager in the audit department of Atlanta & Co., a firm of chartered certified accountants. Alright, see, you are the audit manager. You are the manager in the audit department of Atlanta & Co. Okay, that's fine. And today, remember, the dates are always important. It's 1st July 20x5 today. Now see, you are working on the audit of the RIG group. Okay, the RIG group which has a financial year ending 30th September 20x5. Right, we are working on the audit of RIG group. Since it's a RIG group, so it means that it would be having many subsidiaries as part of it, and you are planning the audit of this company. And further, the year end of this company or this group is 30th September 20x5 and today's date is 1st July 20x5. Alright, the group, a listed entity, again listed is important. You need to mark this point as soon as it comes in your exam scenario. The group, a listed entity, offers an internet television network with over 10 million subscription members in 8 countries. So it's providing its services in 8 countries. Candidates, 8 countries. So there would be some foreign exchange risk, there would be some political factors coming in based on those countries, and there would be some other issues arising due to the timing difference, due to the various regulations differences between the countries. The following exhibits an email which you have received from the group audit engagement partner. Number one, exhibit number one, partner's email, an email which you have received from the group audit engagement partner. Okay. Exhibit number 2, background information. Information and matters relevant to audit planning. So we are provided with the information relevant to audit planning in exhibit number 2. So this means that we are planning the audit and it's 1st July 20x5 with the year end 30th September 20x5. So we are about 4 months prior to the year end, and this means that since the company's year end has not appeared yet, we are already in the process of planning the audit of this group. See, that's why I told you the dates are really important. Now see, exhibit number 3, selected financial information extracts from the group management accounts. Okay. Exhibit number 4, component auditor. So there is some other auditor involved in the audit process of this group. Right? An extract from the audit strategy document prepared by Nigan Associates, the component auditor, which audits one of the group's subsidiaries. Okay, so there's a subsidiary being audited by Nigan Associates, component auditor basically. Okay, and we are provided with the extract from the audit strategy document prepared by Nigan Associates. Then exhibit number 5, potential new subsidiary. Okay, so there's a potential new subsidiary. This means there's a potential acquisition which is supposed to happen. Details of the planned acquisition of a new foreign subsidiary. Again, it's a new foreign subsidiary, another country, Macon company, and a possible joint audit arrangement. Okay, so there's a possible joint audit arrangement involved in this case. Over here, the auditor for this subsidiary is Nigan Associates, and over here there is a possible joint audit arrangement that is supposed to come up. So that these two are different factors, and third, the other subsidiaries which are being audited by our own company Atlanta & Co. Is another third factor. Okay, so this is going to be a very nice question, I believe. You don't have to panic. Don't panic, please. Don't be tensed. This information should be used to answer the question requirements within your chosen response options. Okay. Now respond to the instructions in the email from the audit engagement partner. 46 marks. Note the split of the mark allocation is shown in exhibit number 1. So this means that the partner's email exhibit number 1 is the requirement of question number 1. And professional marks will be awarded for the presentation and logical flow of the briefing notes and the clarity of the explanations provided, 4 marks. But now you know the new audit paper, or the new the new structure of the exam has 20 professional marks in all, 10 for the question number 1 and 5 marks allocated to question number 2 and 3. So over here now the new paper requirement is supposed to be 40 marks for question number 1 over here and 10 marks over here for the professional marks. But you don't have to panic. Professional marks are easy to gain. They are based on communication, that is the logical flow of the briefing note. They are supposed to be based on the presentation, based on the clarity of your answer, based on the calculations you have used. So it's all 10 marks are easy to gain. Just you have to focus on the clarity, on the professionalism, the audit jargon, and the briefing note format and the communication, that is the logical flow. That's it. So these 10 marks over here are easy to gain. Now let us move to exhibit number 1, which consists of the email received from the partner and which consists of the requirements of question number 1. So see exhibit number 1, to audit manager, that is you, from Carol Morgan, audit engagement partner. Subject audit planning for the RIG group. See the subject says audit planning. As I mentioned earlier that today is 1st July 20x5 and the year end for the RIG group is 30th September 20x5. So we are before the year end. This means we are planning the audit of the RIG group right now, because the year end is supposed to come soon. Okay, date 1st July 20x5. Now candidates, I am sure you know the format for the briefing notes. The briefing note format states that you have to write a briefing note, that is the to, in that case becomes the from this email becomes the to in your briefing note answer, and this to becomes the from in your briefing note answer. The subject remains the same, the date remains the same, either you just leave it blank, just mention date, but I would advise leave this blank. Don't write any date over here. Write date and that's it. Colon, that's it, nothing else. Hello, I have provided you with some information in the form of a number of exhibits which you should use to help you with planning the audit of the RIG group for the financial year ending 30th September 20x5. Okay, I require you to prepare briefing notes for my own use, because we are preparing briefing notes for the audit engagement partner based on the planning of the audit for the RIG group, in which now he tells us the requirement A, B, and B has got 2 parts, and then C. So A, using the information in all exhibits, candidates 2, 3, 4 and 5. Evaluate the audit risks, okay, to be considered in planning the group audit. 24 marks, candidates, 24 marks. So we have to calculate, or we have to evaluate the audit risks based on the upcoming audit of the RIG group while we are planning the group audit, and it carries 24 marks. You all know this thing, and I'm sure you know the marking scheme for the RIG, for the audit risk questions. That is, if you are telling materiality, you're telling the treatment, and you're telling what is supposed to go wrong, that is understatement or overstatement, you're mentioning everything clearly. This means that you're gaining 3 marks. But if the question, or if your answer doesn't has any point related to materiality, then you have to tell the accounting treatment, and you have to tell the overstatement or the understatement, and you get 2 marks for that. So based on this, I would suggest, or my suggestion is always go for the maximum materiality parts first, maximum materiality audit risk first, so that you are able to gain 3 marks based on each audit risk you identify. Then, when you are short of marks coverage, you have to go on to the non-materiality questions without materiality calculation audit risks. Alright. B. Using the information provided in Exhibit 4. Okay, so it states that the Exhibit 4, but right now, since it's the beginning of the question, we would only be attempting audit risk in this part of the video. This part video relates to question number 1A. So we would only do this 1A requirement. Let us skip part B1, part B2 and part C for the upcoming videos. Now let's read the exhibit number 2 because it just tells us to read all the exhibits for the question number 1A to find out audit risks. So let us now shift our page to exhibit number 2. Now see exhibit number 2, background information. The group started to offer an internet streaming service for films and TV programs 10 years ago. So the group has been into business for 10 years ago. The group's business model is to acquire licenses for films and TV programs. Customers pay a monthly subscription fee to access them and watch online. Okay, so the group has been into business for 10 years and it provides licenses for films and TV programs. Customers pay a monthly subscription fee to access them and watch online. That's perfect. So we have provided you the background information of the group about the group's business model. Now, the group has a subsidiary in each country in which it offers its subscription service. So each country has a subsidiary for the group where it's providing the same service, the internet subscription program for watching films and TV programs. Okay. Now Atlanta and Co audits all of the subsidiaries with the exception of Darrell Co. Okay, Atlanta and Co is not auditing Darrell Co, one of the group's foreign subsidiaries, which is audited by a local firm called Nigan Associates. Okay, so it's Nigan Associates that's not being audited by Atlanta and Co, the group auditors, right? Now, all companies within the group have the same financial year end, and with the exception of Darrell Co. Okay, so this Darrell Co. Year end is different from that of the remaining group companies, which reports under local accounting standards. So there are two things. Candidates, there are two things. One, the year end is different, and two, it's following local accounting standards. The group companies all use IFRS standards as their financial reporting framework. Okay, so the financial year end is different for Dara & Co. It's following local accounting standards, which is not in line with the remaining group companies which have the same year end 30th September 20x5 and which have followed the IFRS standards as their reporting framework. I hope you are clear about this information. This is nothing much or nothing more except this basic information that the auditors are different for Dara & Co. The year end is different and the accounting standards are not being followed. That is, the IFRS is not being followed with this one. Now, matters relevant to audit planning. Following a discussion between the group audit engagement partner and a representative of the group audit committee, several matters were noted as being relevant to the audit planning. Okay, so the audit engagement partner has had a meeting with a group audit committee member and they have identified following issues relevant to audit planning for the group. And the group has an audit committee because it is a listed group. Now, there is an annual incentive scheme coming up over here. Right? The first issue. For several years, the group has operated an annual incentive scheme for staff under the terms of which employees are eligible to receive an annual incentive payment linked to the achievement of selected targets. Okay, so this is a good scheme by the group, that the group has operated an annual incentive scheme for its staff under the terms of which employees are eligible to receive an annual incentive payment linked to the achievement of selected targets. Okay, the scheme operates across all group companies with some employees' targets linked to profitability, while others are aligned to non-financial measures, including customer satisfaction. Now, candidates, just hold on. See, the group has its annual incentive schemes based on profitability for some employees, and for some employees, it's aligned with non financial measures, including customer satisfaction. See, wherever profit is, a factor for incentives, for incentive schemes, or for bonuses, obviously you are sure as an auditor, as an accountant, you are very, very, very much sure. I am sure you know this thing, that always the employees would show a good profit, good result to bring in more bonus, to bring in more of their incentive scheme share. Are you? I hope you are clear with this thing. And based on the other factors, non-financial measures, it's difficult to measure in this case because customer satisfaction cannot be measured easily. So this is difficult, and profitability, wherever it is linked with profitability, there is a chance of management stipulation, management financial, you know, manipulations. Participants in the scheme are entitled to earn a maximum annual incentive payment of 5% of their salary. Okay, so the 5% of their salary maximum in annual incentive. Approximately 6,590 employees, including the senior executive directors. So it's the senior executive directors who are also a part of the annual incentive scheme, are entitled to participate in the annual incentive scheme. Last year, the average bonus payment was $1,250 per participant. Right? It was $1,250 per participant average bonus payment, and 6,590 employees are being part of this scheme. So let us calculate the figure for this one, because we are provided with the figures. We will use this for the materiality calculation. 6,590 multiplied by 1250 per participant. So this makes it 8.2 million, 82,37,500, which is 8.2 million. Alright, so I am noting this figure with me, 8.2 million. You also note this down on your rough pad, please. We will be using this information later on when we start solving the question. Now let's move on. See, 6,590 multiplied by 1250, 8.2 million, 82,37,500, which is $8.2 million. Candidates, 8.2 million. You note this figure down. We will be using this figure when we calculate materiality. Right now, I have also noted this figure with me on the notepad. You also note it down with you on the notepad. Write down annual incentive scheme 8.2 million. Let us move ahead. Now there's a legal case on the company as well. We provided with a paragraph for this one as well. In January X5, date is always important. Always remember this thing. You need to focus. You need to keep yourself involved in solving questions. You need to mark the dates. Always keep marking, highlighting points, underlining your points from the case as soon as you start reading it. This will help you when you start drafting your answer. You won't have to read the whole case again. Just look for the highlighted underlying points and you would start answering your question. Now see, a legal case was initiated against the group by Glencoe. Okay, there's another company, Glencoe, a film production company. Okay, so there's a Glencoe, a film production company, which has initiated a legal case against the group. Glen Company claims that the group has infringed copyright by streaming a film in specific countries for which a license has not been acquired. Okay, so based on the activities of the group, based on the services the group is offering, there is some license to be acquired by the group, which Glencoe is claiming that the company has infringed copyright by streaming film in some countries where it has not obtained a license. The group insists that the film is covered by a general license which was acquired several years ago. So we are not provided by the figure of the number of years which have passed for the general license the company has or the group has, and the group has or the group insists that this general license covers up the the license for showing any of the films it's showing. The group finance director is not willing to recognize the legal claim within the financial statements. See, it's the group finance director who is not willing to recognize a legal claim within the financial statements. Why? He should have, because it's reliable. We are not provided with any figure over here, but it could be reliably estimated what would be the cost of, paying off to the company for the, what would be the cost or what would be the, legal penalty on the company for this case. So the group finance director is not willing to recognize the legal claim within the financial statements. Okay, but he should, because it it is coming up during the year January 20x5 and the year end is 30th September. So it has happened during the year. Now what's the detail? As he is confident that the claim against the group will not be successful. Okay, the group finance director is not willing to recognize the legal claim within the financial statements as he is confident that the claim against the group will not be successful. But candidates, that this legal claim or this legal case has initiated in January 20x5, which is during this current year. And based on the IFRS or based on the accounting standards, we know that even if we are not, even if we are sure that there's not supposed to be a probable outflow of resources or a probable outflow of money for any legal claim, we need to give a disclosure in the financial statements. We are sure we are not supposed to pay off anything for this legal claim, but we will always give a disclosure stating that there was a legal case initiated against the company or against the group, and the group has not infringed any of the copyrights, and the group is sure that they will win this case. They should disclose this in the financial statements, and disclosure is required. I hope you remember the accounting treatment. And he does not want to discuss it further with the audit team. Okay, so he's not willing to recognize a legal claim in the financial statements, as he is sure that the group will not, as he is sure that the claim would not be successful against the group, and he does not want to discuss it further. He does not want to discuss it further with the audit team, emphasizing that there is no relevant documentation available for evaluation at this time. So it's 1st July 20x5, 1st January 20, or in January 20x5 the case was initiated. It's been about 6 months now, and there is no relevant documentation available for this evaluation at this time, and he is not willing to discuss this further with the audit team, and he is not willing to recognize this in the financial statements as well. So see, there are so many things coming up against this one point, against this one legal case over here. It's easy to identify points in the case. It's easy to make points or identify points in the case, It's just the elaboration, it's just the understanding you get. You have to express your understanding in your own words in the paper and have to tell the treatment for that, and you will pass the paper. I always say, think simple, be simple, and pass the audit paper. That's it. So simple. Think simple. Don't be too, over, or don't be too stressed. Make things simple. Keep things simple. Now see, Darrell Co. This is the subsidiary, foreign subsidiary, which was not audited by Atlanta and Co. Negan Associates provides the audit service to Darrell Co., one of the group's foreign subsidiaries. Okay, nothing in this. Darrell Co. is one of the group's largest subsidiaries. It's one of the largest subsidiaries. It is a listed company in its home jurisdiction with total assets of 140 million. We are provided with the total assets for this group, or for this company, Darrell Co. And we will be utilizing this figure in our materiality calculation. But we are not provided with any other figure right now, so we would hold this figure for further calculation in future. Darrell Co. is the only subsidiary which does not follow IFRS standards. We were told about this in the introduction paragraph. As in its local jurisdiction, companies must follow local accounting rules. It uses the same currency as the rest of the group. Okay, so there is no conversion risk coming up over here. There is no transactional risk, there is no conversional risk coming up in this case, because the currency for the group is the same, and Darrell and Co. also uses the same currency. Darrell Co. was acquired several years ago. Okay, so it's been years since Darrell and Co. is being part of the group, or is a component of the group. And goodwill of $38 million is recognized in the group financial statements in respect of the company. Okay, so it's a 38 million goodwill which was recognized in the financial statements of the group in respect of the acquisition of Darrell and Co. We are not provided with any other figure right now, so we will use this information later on. But we have highlighted this $38 million goodwill and this total assets of $140 million. We have highlighted these 2 points, right? But we are right now we don't have any other information related to this, so we cannot do any calculation right now. Let's move ahead. Now, after exhibit 2, we are provided with exhibit number 3, and this has some financial statement extracts which can be utilized for calculation of materiality, the group revenue, profit before tax, total assets for the group as a whole. So we are provided with the group revenue figures. We will be making use of group revenue for calculating materiality. We can use profit before tax for calculating materiality, and we can base our materiality calculations on total assets as well. Now look at this, projected to 30th September 2025, $1 million. So these are the figures provided to us for the upcoming year. This is not the final figure or not the actual figure, these are projected figures. Then we are provided with actual to 30th September 2024 in dollar millions. This is the last year end figures provided. These are the actual figures for the last year end. Okay. Now there is some note number 1, note number 2 and note number 3. And included in the total assets, intangible assets, that is licenses, it carries a note for this one. And this consists of 580 million in the projected upcoming year end, and $420 million intangible assets licenses in the previous year end figure. But licenses are supposed to be a big figure, because the group is providing internet TV services, internet subscription services in all its subsidiaries, and based on foreign subsidiaries. So it's a licenses need to be acquired for providing these services, and that's why this is a big figure or a huge figure in the part of the total assets. Now, intangible assets, goodwill. There is a note number 3 appearing for this one, and the goodwill is constant 135 million in the projected upcoming year end and 135 million in the previous year end, 13 September 2024. And over here we are provided with number of subscription customers that are projected to be 10 million, 10.5 million, and in the previous year there were 8.07 million customers. So the number of customers has increased immensely. Now we are provided with the notes to the selected financial information. These notes are detailed over here. Now note number 1, that is group revenue, which has increased, was 780 million and which is projected to increase to 980 million, that is 200 million more revenue. So let us read the note to the revenue. The group's main source of revenue is from monthly membership fees. Okay, it's a subscription service, so a monthly membership fee is perfect. Members are billed in advance of the start of their monthly membership. And okay, see, members are billed in advance of the start of their monthly membership. You all are users of the internet. You all are users of the TV service provider, and we all know that we pay for these services. We always pay in advance. These companies do not provide their service without any advance revenue collection or without any advance billing. I'm sure you people all have this experience for these companies: internet service provider, TV service provider, and same goes with mobile cellular service provider. So they all charge us in advance for the subscription or for the service they are supposed to provide for the upcoming month. So this is in line with that same which we all are experiencing in our daily routine or in our daily lives. Okay, and revenue is recognized when the bill is sent to the customer. Revenue is recognized when the bill is sent to the customers. Candidates, don't you think this is something which I should say is alarming? What do you say? Because revenue is, in this case, when you are collecting your revenue, when you are collecting bills in advance, revenue is not recognized immediately. Revenue is recognized over time. For, let's say, this is a monthly membership fee which we are collecting or which the company is collecting from its customers. For, let's say, today is 1st of July 2025 and the company has already billed their customers in advance and collected their payments for these services for the month of July 2025. So don't you think this revenue should be recognized as revenue on a proportionate basis? That is on a daily basis, that is 1st July revenue, 22nd July revenue, 3rd July revenue, 4th July revenue, proportionately it should be recognized as a revenue, whereas the company is recognizing revenue as soon as the bill is sent to the customer, before even collecting the bill from the customer. And the customers, it says all of whom pay by credit card. So it's a credit card company who is also supposed to get involved in this case. The price of a regular subscription has remained at $8.20 per month throughout 2024 and 2025. But see over here, the number of customers has increased from 8.07 million to 10.5 million, right? And so as the revenue increased from 780 million to 980 million in this current year, because the subscription price has remained the same. There's the increase in customers which is projected, an increase in revenue. Occasionally the group offers a free trial period to new customers. Okay, so it's a new customers who are being provided free trial period as well. Then note number 1 continues. This year the group has also introduced a new premium subscription package which allows customers to add 2 family members to their subscription for an additional fee of $5 per month. So see, if you are a customer of this company and you are paying $8.20 per month for your services or the services you are being provided with, and you have got an offer from the company to add two more family members of yours with an additional fee of $5 per month. So don't you think we all would be utilizing this offer by the company? Because we would get a discounted price. Instead of $8.20 per month, we are paying $5 per month. That is only $3.20 lesser than the original price. We all would be utilizing this, right? And this could be a basis for an increase in the number of customers during the year, because obviously many existing customers would have utilized this offer. Now the number two note is relates to licenses. The group requires content licenses per title in order to stream film and TV content to its subscribers. The content licenses are each for a fixed time period, varying between 3 and 5 years. Let's discuss this first. The group has got content licenses which is being acquired with a fixed time period validity of ranging between 3 to 5 years. So each license has a different lifetime and is for a fixed time period. It's not perpetual, it's not on a continued basis, and needs to be renewed after 3 years or after 5 years. Because we are provided 3 and 5 years. Okay, now let's read further. The group capitalizes the cost per title as an intangible asset. Okay, right, because it's having a useful life of 3 or 5 years. So we would obviously be capitalizing and we would be amortizing our licenses year by year. Group policy is to amortize licenses over a 5-year period. Candidates, do you find this point important? We have got content licenses. The group has got content licenses for a fixed time period ranging between 3 and 5 years. It's either 3 or either 5 years license which we have obtained. But the group policy is to amortize licenses over a 5-year period. What implication do you think would happen? I'm sure you know this. Think of it. It's easy. Be simple, think simple, and pass the ACCA AAA paper. I hope you have had some thinking process. Now let us discuss this thing. The group acquires fixed period licenses. It's either a 3-year period or a 5-year period, and it needs to be amortized over the life of the license, right? 3 years or 5 years. Based on their life, they need to amortize this license. Now the group capitalizes the cost per title as an intangible asset. That is perfect. Group policy is to amortize licenses over a 5-year period. Now this is something, which needs your skepticism, professional skepticism as an auditor. Now see, let me explain. If a license has a useful life of 5 years, let's say it's a asset or it's a license for $100, and for 5 years it's being amortized on a 5-year basis, so it's supposed to be $20 per year amortization expense. See, $100 cost divided by 5 years useful life, $20 each year is the amortization cost, which would go into the profit and loss and which would reduce the value in the balance sheet by $20. That's perfect. That is in line with the accounting treatment which the company is following. That's fine. But see now where the issue arises. You have got a license of $100 with a useful life of 3 years for that license. It's $33.33 which needs to be amortized on a yearly basis. Multiplied by 3 makes it 100 again. You need to amortize $33.33 as an expense in your profit and loss statement. But the issue arises over here is that $100 million, and the company is, amortizing all the licenses as a group policy for 5 years. So it's charging $20 as an amortization expense for the year, whereas the amortization expense should have been $33.33 for the year. So this means 33.33 minus 20. $13.33 amortization expense is understated in the profit and loss statement. I hope you are clear with this point. It's not so technical, it's not so difficult, it's simple calculation. So based on this figure, $13.33 expense is understated by $13.33, and when the expense is understated by $13.33, the profit would be overstated, right? And when the balance sheet figure for this license is, amortized by $20 per year, the balance sheet assets would be overstated as well. Right? I hope the point is clear to you. Otherwise, you can comment on the video and I would respond to you soon. Now see, let's read further. The finance director justifies this as being the most prudent accounting treatment. I don't think this is prudent. What about you? Do you feel this is a prudent accounting treatment to amortize licenses over 5 years? He's just trying to make things simple for himself, but the other round effect is financial management, manipulation. Sorry. Now, note number 3, intangible assets goodwill, which is constant. Goodwill arising on business combinations is tested annually for impairment in accordance with IAS 36 impairment of assets. Due to the strong performance of the group, no impairment of goodwill has been recognized in recent years. Okay, that's why the goodwill is constant during the year. Now let us move down to exhibit number 4 and see what it says. The 3 points below are an extract from the audit strategy prepared by Nigan Associates. Okay, we are provided the audit strategy prepared by Nigan Associates for Darrell and Co. in relation to their audit of Darrell and Co. Other sections of the audit strategy, including the audit risk assessment, have been reviewed by the group audit team and are considered satisfactory, so you do not need to consider them. Okay, so these are some audit strategy points which are provided to us because these are not satisfactory. Right, now see, issue identified by Nigan Associates, materiality. Internet services in the country have been subject to considerable disruption. As a result of this, a significant number of customers have cancelled their subscriptions and the company is projected to make a loss this year. This point is really important for understanding. We were provided with the information over here in the previous exhibit number 3, that goodwill arising on business combinations is tested annually for impairment in accordance with IAS 36. Due to the strong performance of the group, no impairment of goodwill has been recognized in recent years. Okay, at this point 1 and one more was over here. Let me scroll up. Darrell and Co. was acquired several years ago and goodwill of $38 million is recognized in the group financial statements in respect of the company. Right? So this 135 consists of $38 million goodwill that is recognized for Darrell and Co. Right? And based on the impairment testing, no impairment is recognized on goodwill up till now. But over here in the exhibit number 4, everything changes upside down. It says that the internet services have been disrupted in the country in which Darrell & Co is providing its services, and because of this, a number of customers have cancelled their subscriptions and the company is projected to make a loss this year. So based on this information provided to you, the company is supposed to make a loss this year, Don't you think goodwill is going to be impaired this year for this company, or is supposed to remain unchanged? Think, candidates, you need to think, you need to make points. Obviously, certainly, the goodwill is supposed to be impaired this year, whereas the company is projected to think that no goodwill impairment is supposed to appear. But based on this audit strategy prepared by Nigan Associates, my understanding says the goodwill would be impaired. Now see, this was the issue identified, this is the audit strategy response by Nigan Associates. Materiality will be based on total assets for the first time this year due to the significant reduction in revenue and profit. So this is not in line with the previous year calculations based on revenue and profit. Now the first time its materiality is going to be based on the total assets of the company Darrell and Co. Based on 1% of the assets, materiality is determined at $1.4 million. In the previous year, materiality based on revenue was determined to be $1.2 million. So the materiality by amount has increased because the company Nigan Associates is changing the materiality to based on total assets rather than the revenue and profit. Now payroll. From 1st October, again date 20x4, payroll accounting services are provided to Darrell & Co by Nigan Associates as an additional non-audit engagement. So it's the Nigan Associates which is providing the audit services to Darrell & Co and non-audit engagement or non-audit services of payroll accounting service. Alright candidates. Now what is the planned audit procedure for this one? Agree the total payroll figure estimated to be $6 million from the statement of profit or loss to the payroll reports generated by Nigan Associates. So Nigan Associates is providing the service and it's only agreeing the total for the payroll figure, not which is estimated to be 6 million. It is not doing any additional working or any additional calculations based on this payroll figures provided by Nigan Associates. Right? There should have been substantive audit procedures on payroll figure to show that this was audited properly, and Nigan Associates, being the auditor and being the non-audit service provider, has done complete work on payroll figures. Okay, you are agreeing with the point I have shared with you, because the procedure is not supposed to be just agreeing the total figure for the payroll figure and then no further audit procedure are considered necessary. How could this be? Right? There need to be substantive procedures on payroll figures for the current year, for the previous years, and there need to be some comparison for the payroll figure from the previous years, from the current year, to estimate that the payroll totals are correct. Sale of property. Darrell Co. sold a small unused building located on the coast to the group CEO in Feb 20x5. Date is important for $50,000. The amount is still outstanding for payment. This is unpaid. The group CEO is planning to use the property as a holiday home. Okay. So the company Darrell & Co has sold its unused building, to the CEO in February 20x5 for $50,000, the payment of which is still outstanding, and the CEO is planning to make it a holiday home, is to use it as a holiday home. Now planned audit procedure. Confirmed $50,000 is included in receivables within current assets. And the other planned procedure, no further audit procedures are considered necessary because the transaction is not material to the financial statements and local accounting rules do not require disclosure of the transaction. Candidates, you need to think. Are these audit procedures correct in this case of sale of property to a CEO of the company or to the CEO of the group? Obviously you need to check first. This is a key management personnel, right? This person, CEO, is a key management personnel for the group. Then secondly, you need to check this $50,000 in respect of this unused property is at an arm's length transaction or not. What is the value of this immovable property, or what is the value of this property in the books of Darrell and Co. Whether Darrell and Co. has made a profit on this sale, or it has occurred a loss on the sale of this property or not. There's so many procedures you can do, but Negan Associates is just confirming that $50,000 is included as a receivable in the non-current assets. It's not checking whether this property has been removed from the non-current asset register or not, and no further audit procedures are considered necessary. How could this be? How could you accept this point? You need to think. You need to make sure. There's so many things. There's so many points you can make. There's so many audit procedures to do on this work, but Negan Associates is not following this. And plus, additionally, the local accounting rules do not require a disclosure of this transaction by Darrell & Co. But the group is following IFRS. The group is supposed to follow the IFRS rules and is supposed to disclose this transaction in its financial statements, because this is a transaction between the CEO of the group and Darrell & Co. So this needs to be adequately disclosed in the financial statements of the group. I hope you are clear about this point. Then the last one, exhibit number 5. The last exhibit provided to us for the audit risk calculation. The group is planning the acquisition of a new foreign subsidiary, Nikon Co., which is located in far land. Okay, located in far land, and we are planning an acquisition of this foreign subsidiary. The negotiations are at an advanced stage. Okay, and it is likely that the acquisition will take place in October 20x5, soon after the year end 30th September 20x5. Now see candidates, the negotiation are at an advanced stage and the acquisition is supposed to take place in October 20x5. Don't you think this is an event occurring after the balance sheet date? This is an event which is probable because it is at an advanced stage of negotiation, right? So obviously the group needs to disclose this in the financial statements as an happening event after the year end, right? Because obviously it's at an advanced stage of negotiation. So there would be some monetary value attached to it, which is, the monetary value also would be predictable at this advanced stage of negotiation. Now see, the group's audit committee has suggested that if the acquisition goes ahead due to the distant location of the company and the fact that Atlanta & Co. has no offices in Farland, a joint audit could be performed with Nikon Co. current auditors, Lucille Associates, a small local firm of chartered certified accountants. Now, Atlanta & Co. does not have any offices in Farland, and because of this, the group audit committee is suggesting that the local firm based in Farland, Lucille Associates, the current auditors of Nikon company, remain the auditors of this company and provide the services as joint auditor over there, right? So with this, we have completed the discussion of the case or of question number 1. Now we would proceed with part A of this question, which required us to calculate audit risk, and because we are provided with exhibits, the exhibit number 2, exhibit number 3, And in exhibit number 3, we are provided with the information based on revenue, profit before tax, and the total assets, which will help us calculate materiality figures for our supporting our answers. And we have to utilize these figures provided, for example, $38 million goodwill, total assets of 140 million over here. The legal case did not have any figure provided to us, and for the annual incentive scheme, we just noted on our notepads $8.2 million. We will utilize this information, these calculations, these figures in calculating audit risk materiality and making points based on materiality first to gain maximum 3 marks for each point we have identified. Then we would, to complete our 24 marks, we would support our answers without materiality calculations to gain 2 marks per point we make, so that we have to cover up. Candidates, you need to make sure that you are fulfilling the requirement of the question marks, 24 marks. This means either 8 straight materiality question points, or you can divide and make maximum materiality points and cover maximum marks. Then you can give the remaining points based on without materiality calculations, so that you make a total of 24 marks. Do not proceed or do not exceed 24 marks calculation, because you would lose your time in the exam hall. The exam hall time is really important for you to meet and to complete your paper. So do not proceed or make extra points other than 24 marks in the exam hall. But for practice, I would suggest you to make points, to brainstorm yourself, to open up your mind, to make yourself more and more skeptical and make more points, identify more points. Let us now proceed with the drafting process. Candidates, now let us start drafting the answer. So let's see, as I told you earlier, that this from becomes the to in the briefing note and the to becomes the from in the briefing note. The subject remains the same and date, it's your choice. Either you give the same date or you leave it blank. My suggestion is always leave it blank. C. To Carol Morgan, audit engagement partner. Carol Morgan, audit engagement partner. Right? From, it's the audit manager, that is you. Subject, audit planning for the RIC group. So audit planning for the RIC group. Date is blank. Right? Now it's a briefing note, so it's supposed to have an introduction paragraph at the beginning of the briefing note. Right? An introduction paragraph for the briefing note is nothing but just what we call a summary or a summation of the requirements provided in the exhibit. That's it, nothing else. You just need to briefly write down these requirements in the introductory paragraph of the briefing note. That's it. So let us draft our requirement based on this. See, in the first part we were given using the information in all exhibits. We won't use this, but evaluate the audit risk to be considered in planning the group audit. For this, we would say that this briefing note evaluates the audit risks, basically, right? So we have to tell this thing in the introductory paragraph. Then comes the part B, evaluate the extract from the component auditor's strategy, commenting on the audit strategy responses and ethical matters relating to the issues identified. because I'm writing an introduction to the briefing note, so I'm reading these parts because of this. Because we need to sum up. Design the principal audit procedures which you will instruct the component auditor to perform on the sale of property to the group CEO. And using exhibit number 5, discuss whether it is appropriate for a joint audit to be performed on Nikon company, commenting on the advantages and disadvantages of a joint audit arrangement. Right? So I'm not going into the details for the part B1, 2 and part C. Right now we're just summarizing these requirements in the introductory paragraph of the briefing note. So I read these requirements due to this reason only. So now let us draft our briefing note. Introduction. We would say these briefing notes are prepared because we are preparing them ourselves to assist in the planning of the RIG group audit, right, for the year ended, because the dates are always important. 30th September 20x5, right? We just told the introduction for the briefing note right now. We haven't used any of the requirements. Now see the part A requirement. Evaluate the audit risk to be considered in planning the group audit. We would rephrase this statement and mention in our answer or in the introductory paragraph. These notes, that is the briefing notes, contain an evaluation, because we are supposed to evaluate the audit risk, evaluation of the audit risk, right? Evaluate the audit risk to be considered in planning the group audit, right? So evaluation contain an evaluation of the audit risks, which should be considered in planning the group audit. You see how I have just rephrased and I have copied the same requirement over here, because we've just rephrased, nothing else, right? Then we will continue with the part B requirement. Evaluate the extract from the component auditor's strategy, commenting on the audit strategy responses and ethical matters relating to the issues identified. Since it's an evaluate the extract, right? So we would again rephrase this further. The notes evaluate the audit strategy, the notes evaluate the audit strategy by the component auditor. Okay, so it was Nigan Associates audit strategy prepared by Nigan Associates, right? And what does it Nigan Associates work on Darrell and Co for the audit of Darrell Co, right? Then in part B it says design the principal audit procedures which you will instruct the component auditor to perform on the sale of property. So what could we say? We would say that associates for the audit of Darrell Co and the audit procedures to be performed on and instruct right? And instruct Nigan Associates for the audit procedures to be performed on the sale of property to the CEO, right? And then we are provided with the part C, where discuss whether it is appropriate for a joint audit to be performed on Macon and company, commenting on the advantages and disadvantages of a joint audit arrangement. So we would summarize this by how would we summarize this? We would summarize this statement by saying that it is appropriate for a joint audit to be performed on Macon company, commenting on the advantages and disadvantages of a joint audit. We should discuss when it is appropriate. Discuss whether it is appropriate. We would say that further we address or we discuss the issue of a of a potential joint, because possible won't sound good over here. Professional skepticism, professional jargon, discuss the issue of a potential joint audit on a subsidiary to be acquired in Farland. Right? See how we have just briefly rephrased the requirements and how we have, told the whole requirement in the introduction paragraph. Nothing else. We have told nothing else. We have discussed nothing else. And you need to, you need to be clear on this, that you need to gain professional marks in this question. 10 marks are available and you need to gain those, and for gaining those you need to be skeptical, you need to be professional, and you need to follow the order properly, communication order properly, that is in a logical flow, part after the part in, like part A first, then part B1 first, then part B2, and then part C, and then a conclusion paragraph at the end of the briefing note. You need to follow the logical flow, you need to be in a flow so that you are able to gain professional marks based on communication. The rest marks are based on the professional marks. In the exam, out of 10 you have got communication in question number 1. Then you've got analysis and evaluation. We will be analyzing and evaluating the information based on our audit risk, based on the professional procedures which we have to provide. And then we've got skepticism and judgment as the third point for professional marks to work on. We have to maintain professional skepticism and we have to exercise judgment throughout the question number 1. And the fourth is the commercial acumen, which you have to follow for the question number 1 to gain the professional marks. But over here in this case, commercial acumen is not so important because it is basically related to the external factors affecting the organization or the company for the audit. And over here in this case, we are not provided with any such major information related to the external environment. Basically, external environment, most of the points cover up the same pastel environment which you studied in P1 or SBL exam over here. Now let us begin and let us draft the audit risks for part A. So we would say over here part A, and we would say we would give a heading to make it look professional and to make it easy for the examiner to identify points. And obviously we will make this bold. Right? Now let's come back to the case. The exhibit 1 we have covered up. So let's move on downwards to exhibit number 2. This was just a introductory paragraph or an introduction over here, so we don't need to copy this, or we don't need to work on this right now. What we need to work on is this starting from here, matters relevant to the audit planning. Now the first point which we have is for audit risk is annual incentive scheme. So let us give the heading for this one, that we are working on annual incentive scheme, so that the examiner knows what points are supposed to come. Annual incentive scheme. It's always a good idea to give headings so that the examiner knows what is coming or what you are going to talk about. Alright, now see annual incentive scheme. Now let us read the points. Over here it's told us that see the annual incentive schemes, it's telling us that the company has this scheme across all of its companies, all subsidiaries are running this scheme for annual incentive, and then we were given that these are linked to profitability and non-financial measures. They are, both of the cases are available, but non-financial measures is difficult to measure. But in this case we are not provided with any information related to this one, so let's skip this one right now. And then it tells us that participants in the scheme are entitled to earn a maximum annual incentive payment of 5% of their salary. You need to know that we are not provided with any information related to the salary. Over here, like in this exhibit number 3, have a look. We were given the group revenue, we were given the operating profit, we were provided the profit before tax, and followed by the classification of intangible assets into licenses and goodwill, and the number of subscription customers. We were given no information related to the annual salary for the group or for individual companies over here. So over here, let's come back to this point. So it says payment of 5% of the maximum annual incentive payment of 5% of their salary, which is not confirmed or which is not available to us. But in this case, what we would do is we would consider this 5% of their salary to be material figure, because it's maximum 5% annual incentive, but we are not provided with any of the figure, so we cannot justify this as material or not, but still we would consider it to be as material. Alright, by nature. So what we would do is we would draft our point based on this one, that we would say the annual incentive scheme could be material, because we are not sure in this case, right? You know this could be material given the 5% of the annual salary, right? Or rather annual employee salary, right? We have rephrased it. Now look at it. This was only a sentence because we were not provided with any other information, no related information, no further information is provided to us. So we would not make any other comment on this. It's just that this information was provided. So we are utilizing this information in our answer, because everything consists of marks. Now let us see what else was given. We were provided with the number of employees approximating to 6,590 employees, with $1,250 per participant as an annual average bonus payment. And we just calculated that earlier when we were reading the question. I have that noted on my notepad. I think you also noted it on your notepad that it was 8.2 million, which was the figure coming 82,37,500. 8.2 million was the figure coming to us, and over here we were provided with the revenue, with the profit before tax, and with the total assets for the group. So we can easily calculate materiality based on these figures, right? And right now what I am going to do is I will base the materiality on, because see, revenue figures are too high, total assets figures are too high from 8.2 million, these figures are too high. So if we divide 8.2 million by revenue or by the total assets, it is possible the answer could be immaterial. I am not giving a final statement over here. I am just indicating the fact that this is possible that it could be immaterial because of the high amounts of group revenue and the high amounts of group assets. So in this case, it's 8.2 million annual incentive, and since this is a profit and loss item, so I'm basing this figure on profit and loss figure 2 to calculate materiality. Over here, see, it's 58.7 million actual profit before tax last year. Because over here we are not provided with the actual profit for this year, we are provided with the projected profit. So I am basing the figure on this actual profit, which was last year's profit, to calculate materiality. Now see, we were provided with 8.2 million divided by the last year's profit 58.7 million, and this gives us 30 multiplied by 100, and this gives 8.2 million divided by 58.7 million multiplied by 100. So this gives us the answer 13.9693356%, which is approximately 14%. Candidate, you know this. It's 14% materiality. So materiality based on profit before tax is 14%, and this is material. And further, we were provided with this information over here that the group finance director and the employees, that the senior management and the employees are also a part of this annual incentive scheme, and they are since they are linked with the profits, since they are the part of the annual incentive scheme, they have an incentive to manipulate the figures, right, to extrapolate the profits, to reduce the costs, to increase the revenue, to show more profits so that they can gain more bonuses, more annual incentive payments can be received by them. So right now we have discussed the answers which we write in this case, and we are going to elaborate these in our answer over here. So next point which I am going to make, or which we are supposed to make, would be the total bonus or the total annual incentive, not bonus, because the wordings in the question were annual incentives. The total annual incentive scheme payable, we calculated 8.2 million, right, is $8.2 million, right. I'm not writing the whole figure, and it's making it easy in converting it into million, because the exhibit number 3 shows us figures in millions for the profit before tax, and 8.2 million, which represents 14% of the profit before tax, or we can say of the actual profit before tax last year, right, and therefore it is material. You're getting my point? Material to the financial statements. Material to what source? Material to the financial statements, right? You see how we have crafted a point for this one. Now we discussed earlier that employees and senior management is involved in the profit annual incentive schemes, and based on the profit they have a high chance or high probability of manipulating the profits. So we can give that there is a possibility of management biasness, and that the figures could be manipulated. Let us draft a point for this one, because we just discussed this thing. I hope you are clear with this thing. Employees and the senior executives whose payment is linked to profit, because they were non-profitable factors also, whose payment is linked to profit, have an incentive to maximize profits, right? What would happen? We would say there is a risk of management bias, right? And what else? Since it's a planning case, you need to write down your answer in the form of a planning. So it's there's a risk of management bias in the financial statements. Right now we are doing planning at this stage, so we would say the audit team needs to be skeptical, right? The audit team needs to be skeptical and alert to any situations to any situations basically of overstated revenue and profits, right? And rather we can say and profits or understated costs, right? You see how we have drafted the point. We calculated materiality as well. I hope you are clear with this thing, how I have drafted the point. Now let us shift on to the legal case which was mentioned in January 2005. See, I am just reading the highlighted points. Gland Company was the one who filed a case or suited a case against the group, and the group had a general license acquired several years ago. The group finance director thinks that the case would not be successful, and he does not want to discuss it further with the audit team as no relevant documentation was available. You see the advantage of highlighting or marking the points while reading the scenario. I just read the highlighted stuff and came up with the whole gist or whole summary of the legal case instead of reading the whole 3 lines, then 1 line, then again 4 lines. It wastes time during the exam. You need to be confident. You need to mark these in the exam. See how we save time. Within a minute, roughly a minute or less than that, we finished up with the highlighted points and we've recalled all the points which was mentioned over here. Now since its heading is legal case, we would give the heading legal case over here. Right? I hope you are clear with this thing, because based on what I have observed, it's easy, and I've been focusing and I've been continuously telling you it is easy. Don't worry, don't panic. Everything is easy. Just think simple, be simple, and pass the paper. It's so simple as that. I cannot make it more simpler than this. Okay. So let us draft a point for the legal case. We just recalled the information provided for the legal case, that there was no certain figure, there was no disclosure which was being made, and we discussed earlier that the disclosure was necessary. It was a requirement of the IFRS that the disclosure should be coming up in the financial statements. IAS 37 requires this thing. Contingent liabilities and contingent assets, right? This requires it. So we would tell the treatment also. Okay. So let us begin. We would say Okay, let us begin. We would say first we are telling the accounting treatment. If there is a possible obligation at the reporting date, that is 30th September 2025, right? Then disclosures or disclosure of the contingent liability should be made in the financial statements, right? See, I have just told the treatment over here. Now, based on what we have, we would tell about the finance director first, that the group finance director refuses to discuss the case with the audit team, right? Rather, you continue. Based on this, there is a risk whether the situation, you say whether, because we are not sure it is going to give rise to a contingent liability or not, whether there is a, let me correct it, there is a risk whether whether this gives rise to a contingent liability and a provision should be recognized or no, rather, just a second, let me read it again. The group finance director refuses to discuss the case with the audit team. Based on this, there is a risk whether this gives rise to a contingent liability and a provision should be recognized along with disclosure in the financial statements, right? Now, based on this, if there is no provision recognized and there is no disclosure in the financial statements, there what audit risk comes up, right? So the financial statements become misstated. We could say there is an audit risk, right? There is an audit risk that if the if the provision is not made in the financial statements, okay, the expenses would be understated, right? And the liabilities will also be understated. See how we've drafted this point. Legal case 1, 2, 3, 4, 5. It's 5.5 lines. We have written out the whole thing, or we have summarized the whole thing, and we have told the treatment first based on IAS 37 that if there's a contingent liability at the or a possible obligation at the reporting date, a contingent liability should be recognized and a disclosure made in the financial statements. But in this case, the information tells us that neither of these things have been done. So based on this, the expenses could be understated and the liabilities could be understated as well. I hope you are following. I hope you are able to think the way I am thinking. You are able to, grasp what I am saying. Right? Now let us go back to the case. Now it tells about the Darrell and Co. But I think it would be a better idea if we could tell something about this finance director first. Because finance director's role is, I don't like it. So let us go ahead. Finance director attitude. Right? The correct wording. See, he was not willing to discuss with the audit team and he is confident that the claim against the group will not be successful. Right? But we can make so many points based on this finance director's role given to us in this one paragraph. See how I am drafting this point now. It's like, a point which you need to think of. You need to be skeptical first. You need to be skeptical in the paper. Right? So we would say that, let's begin. The finance director, we are telling the case first, is reluctant to discuss the legal case with the audit team. Right? This is copied from the case. It's no hard and fast rule. We haven't done anything up till now. Right? But now what we are going to do? Now we are going to comment why is this an issue. Right? So we could say that this could be an attempt of deliberately obstructing the audit teamwork, right? And if he is doing this, if he is imposing this obstruction, if he is obstructing the work of the audit team, what would happen? Limitation of scope, right? So this, what do you call it? This imposes a limitation of scope for the audit team. You see how we crafted a point. We made a point out of this one paragraph which was provided to us in the case. But one more thing, we can make another point too. We could make another point too. See, he's not willing to discuss first, and plus he's confident that it should not be disclosed, as he's confident that the claim would not last long or would not be successful. So kindly draft a point based on that. We can say that this increases the risk that the legal claim will not be recognized appropriately in the financial statements, right? Why? What would happen? Think of it. What do you think? We are planning the audit, so I am now making a point based on planning of the audit, right? So this increases the risk that a legal claim will not be recognized appropriately in the financial statements, and the audit team needs to exercise higher professional skepticism, right? Or we could say in the financial statements, and the audit team needs to approach this with needs to approach and exercise higher rather no needs to approach this issue with higher professional skepticism. Right now it's correct wording coming up. So you see how we've drafted a point, how we've drafted 2 points for the finance director's attitude from this one single paragraph which was provided to us based on the finance director's attitude. Right? Now let us come down to this Darrell and Co. See, Darrell and Co is a listed entity with its total assets of $140 million in all. Right? Now, and we were told that if we were told in the exhibit number 4, let me scroll down, that this year it's supposed to make a loss, due to which we were discussing the point of this materiality, goodwill, that up till now the business combinations have not recognized any impairment on goodwill. But now, since Darrell and Co is going to suffer a loss in the current year, don't you think there would be some impairment on this goodwill now? Because since this is a projected figure, and according to the projection, there was no goodwill supposed to be charged, but now, based on the information provided to us, I feel we should have an impairment test for goodwill, or the goodwill should be, measured for this group, Darrell and Co, for this company. And the goodwill for this Darrell and Co was, let me read out. Let me find out. We were provided with the information related to goodwill amount in this case for Darrell Co. Let me see. Just a second. Yes, here. Darrell and Co was acquired several years ago, and goodwill was of 38 million is recognized in the group financial statements in respect of the company, and up to now no impairment was conducted for the goodwill. But now we would calculate materiality, because based on this we have been provided with a figure of goodwill 38 million. We would use this figure for calculating materiality. Look, we have got total assets 780 million, so 38 million goodwill divided by 780 million assets multiplied by 100. So this gives us 4.8%, 4.87179%, that is 4.9% is given to us as materiality figure for this based on the total assets. So goodwill is material, right? Now let us draft a point for Darrell and Co impairment of goodwill. Darrell Co goodwill impairment. Right? Now again we would make it bold to make it easy for the examiner to recognize this point and to understand what we are supposed to come up with. Right? Now we would say we would begin by the goodwill of $38 million in relation to Darelco is 4.9% of total assets and is material to the group financial statements. Because it's the group financial assets which we are doing. Right? Now we would give the treatment first, right? So goodwill should be tested for impairment annually, because the IFRS tells us this treatment, right? And this is in line with the group policy, because the group we are provided with information that the group is conducting impairment annually. Over here, see, I am not making any point from myself. It tells us in this one, note number 3 is tested annually for impairment, right? So we are provided with this information and I am just copying the information from the case. It's nothing produced by myself. Now let us come to exhibit number 4, the audit strategy prepared by Nigan Associates, which we discussed earlier. We would say that see, this audit strategy tells that this is a loss-making company for the current year, and based on this we have calculated the materiality for goodwill, and based on this information it is a possibility that this goodwill could be impaired, right? It is an indication of impairment. Now let us come back and draft this point over here further, that the audit strategy prepared by Nigan Associates indicates that Darelco is a loss-making company this year, right? Which is a sign, or rather, which is an indication. Sign doesn't sound good, which is an indication of impairment of goodwill, right? See how we have drafted the point. Now if the goodwill is impaired, what effect would this have, right? So let us write down the effect. If the impairment loss is not recognized in the financial statements, what would happen? The expenses would be understated and the profit for the year will be overstated, right? One thing is understated and the other thing is overstated automatically. But what would we do further? Dude, don't you think that, see, The profits are overstated and the expenses are understated based on the goodwill and based on the finance director's reaction, or no, rather based on the goodwill not being recognized or as impaired. So don't you think this would have overstated profit, right? And the overstated profit is directly linked with the bonus or the annual incentive scheme. So yes, now we will draft another point after this based on the annual incentive scheme, right? So we can write another point over here. We can continue. There is an incentive, right? For not recognizing the impairment loss because of the annual incentive scheme, which is directly linked to the profits. Now you think of it. You have the point written in front of you. Don't you think this is a valid point I have made? That the bonus scheme or the annual incentive scheme is directly linked to the profit, and management bias could be due to this reason that the management is not recognizing an impairment loss. This we have identified from the information provided to us that there should have been an impairment loss recognized. Right? And now, since we are planning the audit and the component auditor, that is the auditor for this Darrell & Co is not the same as our company Atlanta & Co. So we would have to evaluate the work, or we would have to test the efficiency or test the how much reliance can be placed on their work. So we can draft a point based on this one also. We can say that Nigan Associates, right? Now based on this one, let us draft a point for Nigan Associates. Rather, it is a generic point which we are supposed to make, because no such information is provided in this case in the scenario. We would say that the audit team needs to consider the extent of reliance that can be placed on Nigan Associates work. Right? This is a simple point which we have made, but we can say that what would be tested, right? The independence, because the Nigan Associates is providing is payroll service as well. So the independence and competence of Nigan Associates needs to be measured reliably, right? I hope you are able to follow this point. Tell me truly, or tell me, be fair. Tell me, were you able to think of this point? That we could draft a point for Nigan Associates, we could draft a separate point for the finance director's behavior, attitude. Tell me, be honest, don't worry. I won't scold you. But you need to be skeptical, you need to think of as many points as you can, you need to brainstorm yourself to become, perfect in this case. And now, like we were provided with the information of Nigan Associates providing the payroll services, so we have told about we would measure the independence of Nigan Associates, but we would share this point that we are, aware of this point too. The independence of Nigan Associates might be threatened. Why would it be threatened? Might be threatened due to the non-audit service it is providing to Daralco, right? We have told this point also. We shared our information based on this point as well with the examiner. Now coming back to this point, over here till we have covered the exhibit number 2 and exhibit number 3 based on the information provided. We have covered the exhibit number 4, that was a loss making company, right? And based on this, what else can we do? No, rather wait. Let me come back up. Let us come back up. Exhibit number 3. See, we were provided with so much information based on the revenue figures over here. Don't you think we have got a lot of information for the revenue draftings? We can draft so many points for the revenue over here. Right, so first let us work on the revenue figures, then we would carry on forward, right? Now let us have a look at the group revenue, which has increased from 780 million and is expected to increase to 980 millions. So you see, it's $200 million increase in revenue in a single year. Isn't that significant? Apply professional skepticism. See, it's 200 million. 200 million is like a huge amount. I know it's a group as a whole, but don't you think 200 million? Now let us see what let us calculate the percentage increase. 980 minus 780, 200 divided by 780, that is the previous year's actual revenue, and this shows us 25.64% increase, 25.6% increase in revenue within a single financial year. Don't you think this is a huge amount? It's such a big amount, right? So let us draft our first point based on this calculation, the increase in revenue. So let us give a heading, revenue analysis, right? We are analyzing the revenue figures, and mind it, the new marking scheme as professional marks for analysis and evaluation. So you need to focus on comparisons, on calculations. You need to focus and make maximum use of these in a good way to score professional marks easily. Maximum professional marks should be obtained by you. Now see how we will draft our answer for the revenue analysis, which we just did. We would state the financial statements show an increase in total revenue of $200 million for the current year, right? Or the financial statements show an increase in total projected revenue, right? We are utilizing the projected figure, projected revenue of $200 million for the current year, right? Now we will tell about the increase in percentage. This is a 25.6% increase, right, in revenue within a single financial year, right? This, because we are writing the answer, we would write that this could be an indication of overstatement of revenue. Do you think so? Tell me. I hope you are clear with this. That $200 million increase in revenue is significant. It's totally too much, and we calculated the increase. It's 25.6% increase in revenue within a single year. So it could be a possibility that it could be overstated. The revenue is overstated. Why? To show higher profits. Why to show higher profits? Because the incentive scheme is based on profits. So you see how each and every point is linked, how the whole scenario is linked. One thing is leading to the other thing is leading to the third thing, and the third thing is eventually leading to the annual incentive scheme which is being operated by the company or by the group. You see my point? Now one more thing what we can do is we will do a deep study over here. That over here in this case, see, the revenue was 780 and the number of customers was provided to us 70,000, and in this case it's 980 million and the number of customers is 10.5 million. So we can calculate the revenue per customer and have a deep analysis or a deep study for this one too. So let us calculate 780 123 divided by 8070123. So it's roughly $96.65 per customer in the 20x4. Now let us calculate for the current year, the projected figures, and over here we are provided with the figure 980,123,123 million divided by 105,00123. So it's $93.33 per customer. So the revenue figure is falling, right, per customer. It was 96.65. I have noted this down on my rough paper. I hope you are also noting this down. And it is supposed to fall to $93.33 per customer in the current year in the projected figures. Now what do you think? What is the reason behind this fall? Right? You need to think. But based on this working which we just did, let us draft our answer. We can draft a single point for this one. The revenue per customer in 20x4 was $96.67, right? And in 20x5 it is $93.33, right? We just calculated these two figures. We gained 2 marks for this working. We are not showing the working, but at the back end we have calculated the figures, and this shows that we have done some working. Based on this we have calculated these figures, and obviously our figures are correct, so this is going to gain us marks, right? You are getting my point. Now one more thing I want you to further analyze is, look, we were provided with the figure 96.67 per year figure for this 20x4. If we divide this figure by 12, we get $8.05 per subscription per customer per month, right? And if we have a look at 93.33 divided by 12, So it gives us 7.775. I am noting this down. You also note it down. In 20x4 it was $8.05 I've noted for per customer per month, and in 20x5 it is projected to be $7.78 per customer per month. Don't you think this is not in line with the premium package, premium service which the company has started offering? Let me show you this one. The group also introduced a new premium subscription package which allows customers to add 2 family members to their subscription for an additional fee of $5 per month. So won't this bring up some additional revenue per customer? Yes, you're right. It should have brought in more revenue. The revenue figure is increasing, but per customer per month the revenue figures are falling, and it tells us 8.20 per month is the figure given for the revenue, and it's constant throughout this period. Then how come the revenue is falling? Right? Now let us draft these 2 points together in our next paragraph. See, how would we draft the answer now? Revenue per customer per month in 20x4 was $8.05, right? Whereas in 20x5 it is projected to be $7.78, right? This we just calculated. I hope you have noted it down on your rough paper. Now, what is the issue? This seems to contradict with the as premium subscription service being offered by the company, right? So we would mention this contradicts with the premium subscription offered by the group, right? We are linking with the case 2. Why is it contradicting? Because this contradicts with the premium subscription offered by the group, which should have increased the revenue per customer, right? See how we are analyzing and how we are making points. You need to see, you need to observe this point too. Now let us come back to the case. Let us think of another point over here. We would utilize this point over here, this information given to us, that the revenue per customer has remained the same. Then how is the revenue per customer falling? We would mention this in the same line or in the same paragraph. This is unusual. Why is this unusual? Because the subscription charges of $8.20 have remained constant for both the years. See how we are telling the point. We are just sharing the information given to us in the paragraph, that this revenue figure or this subscription figure has remained unchanged for a year. Then how come the revenue per customer per month is falling from 8.05 to 7.78? You see this point? How could this be? Now let us read this some more information over here. I think uh, look, occasionally the group offers a free trial period to new customers. This could be a reason, right? Because it's a free trial period to given to customers, so the number of customers might be increasing because of this over here, and eventually those customers would not be taking up the subscription at the end of the trial, and due to this the number of customers or number of subscriptions customers is increasing, but the revenue per customer is falling. This could be a possible reason. Don't you think so? So we can let us draft a point based on this one too. See how each and every line of the scenario is important. We would say the figures for revenue per month per customer could be impacted due to the free trial offered to new customers. Don't you think so? But since we are at the planning stage, we would say that these trends need to be further investigated by the audit team, right? We did analytical procedures on revenue, and we are at the planning stage, so we are telling about that this should be further investigated by the audit team. Right now, let us give this a stop and let us have a look at one more point I was coming up with. That, see over here, the revenue is recognized when the bill is sent to the customer. So when the bill is sent to the customer, before even it is received, the revenue is recognized. Don't you think it is an early recognition of revenue in this case? Right? I think you are right. You are right that this is an issue. It's not in line with the IFRS revenue recognition. It does not meet the criteria, right? So we could state this one as well. We will make a point on this one. See how each and every line or each and every sentence has a point given to us for examining further, and how we are elaborating those points to make our to get our marks. Right. So let us draft a point based on this early recognition of revenue. Now we would say that based on the invoicing, right? Let us say that this the group is invoicing customers when the invoice or slash bill is sent to the customer, right? This is an early recognition of revenue. Don't you think so? I hope you agree with me. Now, what would early recognition of revenue bring in? It would bring in, obviously, early recognition of revenue would increase the total revenue, right? So now we will tell the accounting treatment that revenue is recognized when a performance obligation is satisfied by transferring a promised good or service, right? This is the accounting treatment. So we have told the accounting treatment, and we have already told that this is a case of early recognition of revenue. Now, what would this have an impact on? There is a risk, right, of overstatement of revenue, right? I hope you followed what I did, right? So with this, we have completed our revenue analysis. Now we need to draft more points. You need to think of this. I want you to think of the other points which we could do. Now we were provided with the licenses point number 2. The group acquires content licenses per title in order to stream film and TV content to its custom subscribers. The content licenses are each for a fixed time period varying between 3 and 5 years. This is the life of the content licenses which the group acquires. But the group policy that being prudent, the accounting treatment being prudent, is to amortize them over a 5-year period. We haven't made any point for this yet. I hope you recall that we were discussing that this would understate the amortization expense, increase the profits, and eventually it would lead to the annual incentive scheme, right? So let us draft a point for this one. We would make a heading for this one. Let me scroll down. Amortization of licenses, right? And as usual, we will make it easy for the examiner, so we will make it bold, so the examiner knows what exactly to look for in this paragraph. I hope you're following me, and I hope you're with me. I hope I'm not going so fast. I'm going in the same pace as you are. One more thing over here. See, the licenses have a projected value of 580 million, and they are part of the total assets of the group. 580 out of 780, so it's going to be a significant amount, material and highly material. So let us calculate first, then we would give the answer. 580 divided by 780 multiplied by 100. So this gives me the answer of 74.3589, which we can say 74.4%, and 74.4% out of the total assets is significant. Don't you think so? So let us draft our answer. The licenses recognized as intangible assets are highly material to the group total assets, as they represent 74.4% of the total assets, right? The highly material. Now let us further elaborate. I hope you are following what I am doing. Now we would comment on this point that the licenses have a useful life of 3 to 5 years. This is supposed to be drafted now. Let us draft this point. Each license has a fixed time period or fixed period, right? To amortize the cost of the license right? The cost of the license over the fixed period, right? Now we have told this thing over here. Now what we would do, right? No, rather I'm not comfortable. Each license has a fixed time period to amortize the cost of the license over the fixed period on a systematic basis, right? Because depreciation and amortization was always done on a systematic basis. Now it's fine. Now what we would do is we would tell the group's accounting policy to amortize them over a period of 5 years, and the finance director justifying this as the most prudent accounting treatment. So let us draft a point. The group accounting policy is to amortize all licenses over a period of 5 years, right? First we have told the group accounting policy, and now we would tell that over a period of 5 years, whereas the actual period for licenses vary between 3 to 5 years, right? We told what the group accounting policy is and what the actual life of the licenses is. Now we would say that as a result, the amortization may not be accurate, right? As a result of the amortization may not be accurate, and what would the effect be? We tell the effect may not be accurate, resulting in misstatement of intangible assets, right, and overstatement of profits. Rather, let me think. Let's read it again. I think there's a we can make a change. As a result, the amortization may not be accurate, resulting in overstatement. Should have been over here because misstatement is nothing in the audit paper, right? Overstatement of profits and overstatement of intangible assets because the expenses are understated. And now one thing which we are left with is this thing, the prudent thing which the finance director says it's the most prudent policy or the most prudent treatment. We can make a point for this one. We can say that the finance director assertion that the accounting policy is the most prudent is not appropriate, because we know that this is not appropriate, so we are clearly stating the fact. And why it is not appropriate? It could be, we are linking it with the annual incentive scheme. It could be a means of earnings management, right? How it could be an attempt, that is to minimize amortization costs and maximize profits. Thereby getting an incentive in the annual incentive scheme, right? See how I have drafted the point. I drafted the point by making it simple. I made it simple. I just mentioned what is the accounting treatment and what the director did, and the finance director, and how it is a kind of earnings management scheme which is going to result in the higher profit and higher annual incentive scheme incentive, right? Now let us come back to the case. Now I am coming out to exhibit number 5, the possible acquisition of Nikon company. We highlighted that it's at the advanced stage of the finalization, and it is can be estimated that it's supposed to take place in October 2025, that is soon after the year end. So won't we have to make a point related to this? We won't have to give a disclosure based on this in the financial statements year end, because it's an event happening after the year end, soon after the year end, and it's at the advanced stage, so it's quite probable too. So we can make a point for this one over here, that Nikon company acquisition, right? Now we can say that the acquisition of Nikon company is planned to take place soon after the year end of 30th September 20x5, right? So we can say it is a significant event taking place after the year end, right? And it requires a disclosure in the financial statements. Right, we have stated the fact that this is a thing which needs a disclosure, right? Now what we could say is there is an audit risk, because you're going to perform the audit. There is an audit risk that the disclosures in relation to the acquisition are not complete or adequate in the financial statements. So with this, I think we have covered each and every point which was supposed to be covered by now, and now I think it's the end of part A, which we covered up till here. Now we will move on with the part B in the next lecture, and we will follow the part B in the next lecture now. Alright, so let us continue in the part B. Have a good time and focus on your studies. Let us go to the next lecture, part B. Okay, see you. Now since we have completed question number 1 part A, and it consisted of 24 marks, I want you to see and have a look at how we have covered up the marks. See, the Professional marks are separate, so we are not counting the professional marks based on the heading, the to, from, subject, and the introduction paragraph. I'm not counting those. I'm just talking about the audit risk part A. That's it. So see, we've covered up 1 mark over here for this first sentence, 1 mark over here 2, and 1 mark over here 3. So we have covered up 3 marks over here, 1 mark for this legal case, 1 mark for this one, and 1 mark for this one. 6 marks in all. Then have a look. 1 mark for this one, 1 mark for this one. 7 and 8, right? Then comes the goodwill impairment. 9, 10, 11, 12. We have covered up 12 marks till here. Then see 13, 14, 15, 16, 17, 18, 19. We have covered up 19 marks till here. Then comes this amortization, 20 marks, 21, 22, 23, and then 24 and 25 marks. We have covered up 25 marks in this part A of audit risk out of 24 marks to be calculated. So see, it is easy to cover up marks. It is easy to make points. There could be more marks, there could be more points you can make. You can draft more points easily and gain more marks. It doesn't vary. The examiner gives a free hand to make points whichever you like, whichever you want to make. So over here, see how we've covered up 25 marks out of 24 marks available in the question. So you can make points, you can gain marks, and you can clear the paper easily. Let's move on to the next video, part B1. Towards the end of this video, you need to remember, greatness doesn't happen overnight. It's the result of continuous effort, boundless curiosity, and a thirst for improvement. Investing time in these videos and engaging with past AAA exam questions is an investment in the brighter future you're shaping up. Keep your focus sharp, your learning continuous, and your eyes focused on your goals. Best of luck as you navigate your studies. May your dedication lead you to success in the AAA exam.